Right. Well, welcome everyone to our June session of our monthly market update. As always, we'll have good information for you. Adam Bruner from Flagship Home Loans on the call with us. You guys should know me, your director of training. And unfortunately, Jake Brendel from Goosehead Insurance, our usual insurance rep and fountain of knowledge, is sick. Himself and his kids are sick with some sort of virus. So no fun, and he will not be joining us this session. So we'll see him in July. So I will let Adam take it away with mortgage information and news.
Awesome. Thank you so much, Danielle. Want to thank everybody for joining and tuning in today. We're going to cover two things that I think are very interesting. The first one is that the House Financial Services Committee has proposed and approved a bill that would eliminate trigger leads. For the agents that are on the call, how many of you are aware of the trigger lead calls that some of your clients get when they go through the pre-approval process? Is anyone aware of those? Um,
No.
so what happens with, I would say, somewhere around 20 per, I would say 1 out of 20, okay, about 5% of the credit pulls that we do, our clients start getting bombed with phone calls. And I mean, like, as soon as I pull that credit, their phone's ringing, and it's like two or three calls every couple minutes, and it lasts for a couple days. Some people, they're like, I've received hundreds of phone calls. It's usually not hundreds of phone calls, but it sure feels like it. And what that is, certainly we are not sharing any information with buyers, but there are something called trigger leads, and it's triggered by the mortgage credit pull. And it comes from the reason why only 5% of the people get them is somewhere along the line when they were applying for either a credit card or a mortgage or insurance or possibly even a car loan, there's a little checkbox that says, would you like to be notified of lower interest rates or lower insurance rates? Who would not check yes? But really, what it is it's giving permission for the credit bureaus to sell your telephone number that they have on record to companies that buy into their programs. Okay. And a lot of times it goes to call centers. Those call centers have technology that start cranking out phone calls right away. And then when somebody picks up, it actually goes to a loan officer. It's not even an individual that's calling, it's usually a robot that's calling that connects them with a loan officer when they pick up. It's very annoying. It takes about 5 days to get off that list, which I'm going to show everyone at the end how they can get off that list. But long story short, there is a legislature that has proposed that if it goes through, would eliminate those trigger calls. Now, the problem we have is if we don't get out in front of that, or if I'm not aware that the borrower is getting those calls or the buyer is getting those calls, they could be very upset with me thinking that I might have shared their information. And certainly we did not do that. I don't want any other lender calling them. Um, so that's kind of the idea of it. Danielle, if you could pull up that first sheet that I sent you there. Um, so what this is what I send clients, and I can send this to you. I have this chalked up as a saved email. It happens so often that I send it right out to clients as soon as I hear they're getting the calls. And what it does is it first of all it explains to them that we did not share their information. It explains to them that they likely checked a box that was veiled as helping them with lower interest rates or lower fees. But really, what it does is it sold them as a trigger lead. And what they need to do to make those calls stop is basically three things. Number one, and it's the most important one, they have to opt out of that pre-screen registry. And it lasts for 5 years. There's instructions. You log on to that website, you scroll down to the bottom, you click the blue button. On the next page, you click electronic opt out for 5 years, click the button and then fill out the basic info, and then click the blue confirm button. The basic info is just like name, address, date of birth. You do have to give, I think, part of your social security number there. The second recommendation there is to get on the National Do Not Call list. Now, this is more in line with the TCPA. I'm sure Danielle is very familiar with TCPA laws. Large legitimate companies take TCPA laws very, very seriously. But a lot of small companies and a lot of rip-off companies, they don't care about them and they blow right through the TCPA laws. So number two there is to get on the National Do Not Call Registry, which is part of the TCPA laws. And then the third thing is to ask the company if they continue to call you. You have to ask them to put you on the Do Not Call list. It really isn't okay to just say, please stop calling me, or you're bothering me, or just being really angry on the phone and hanging up. Chances are they're going to continue calling you. You have to say, put me on your do not call list. And I go one step further. I say, ask that person for their full name and their telephone number or their NMLS number, and then ask them to be placed on the do not call list. And like I say at the bottom there, legitimate companies take it very seriously, and they immediately should put you on a list where you don't receive any more calls. If you get more phone calls, though, you could potentially have a lawsuit on your hands where you could sue that company if they didn't follow protocol for TCPA. And there are companies that have had to pay millions of dollars for some phone calls that went out at 7:30 in the morning because they were calling on the West Coast when they were on the East Coast. There's a lot of different violations there or I should say, there's a lot of protections with the TCPA laws. So again, the big news is that the House Financial Services Committee has proposed and approved a bill that is now going to go in front of Congress to eliminate trigger leads. And that's what it stems from. Any questions about that from the group or anything to share? Okay. Moving on to the next one, and this is the one that I think we can start to use right away. Um, I want to talk about the real cost of waiting to buy a house. Who has not heard from a buyer or a borrower or someone out there that says, you know what? I'm just going to wait for interest rates to come down, or I'm going to rent for another year, or let's just wait and see what happens. Well, I actually decided to crunch some numbers and let's look what actually happened over the past year. Anybody can fudge the numbers and say, well, here's what might happen in the future. Let's look what happened over the past 12 months. Danielle, if you want to bring up that second PDF file that I sent you. Now, I pulled these numbers directly from online resources like Realtor.com, Zillow, Mortgage News Daily, and also Redfin. So these are vetted, published numbers.
Oh, shit.
And what we're looking at here is the numbers from May 2024 to May 2025 is the best, most current information that we could use. And again, my purpose here is let's look at what happened to your average borrower on an average down payment with an average loan amount that waited the last 12 months. Okay. If we go back to May of 2024, now this is just in the state of Pennsylvania, folks. So anyone out of state, massage it for your own state. But hey, here's some good information with good numbers. The average home sale price in May of 2024 was $295,691. Got to get that one extra buck in there to be accurate, right? That was your average home price in the state of Pennsylvania. Okay. Over the past year, depending on where you look at your information, some were saying that home values appreciated by 3.5%. I had seen in some areas it was as high as almost 9%. So I kind of took the middle there, and the average that I got was about 6.1% appreciation. Does anyone dispute that they have seen home values go up 6% over the past year? I was actually curious to see if anyone had feedback on that. So the average home price went up about 6%. And today, the average home price in Pennsylvania is about $314,900. Okay. Now, the average down payment, when you factor in obviously FHA lower down payments, conventional, you start to see averages up above 10%. But at the end of the day, it comes out to about 8.1% average down payment. So I took 8.1% down payment on those purchase prices from that year, and we could see that the average loan amount in May of 2024 was 271,740, and today it's a little bit higher at 298,393. But let's look what happened at the rates. I know 12 months ago I was saying to everybody, Fannie Mae and Freddie Mac are going to be dropping interest rates. It's going to be raining money from the sky. The mortgage industry is going to be great. We're all going to be selling the houses again, and it's going to be rates down in the fives. Well, it didn't happen. Rates actually only dropped by about a tenth of a percent. Now, there was variances in there. We saw rates go down as low as an average of about 6.5% at a certain point this year, and they've also been as high as like seven and a quarter, 7.375. But all in all, interest rates have hovered right around 7% with just a little bit of improvement over the past year. So someone that waited, yeah, they got a better interest rate. They got a better interest rate by about a tenth of a percent. Well, what did that do to their monthly payment compared to their average loan size? Well, look at that, folks. Average monthly payment, even though the interest rate went down, average monthly payment is
What's
about
that?
$96 more per month
Where did it
for the
in?
same house. Same house, 12 months later, payment went up by $100. And over the life of the loan, now this is a little bit of a number that's not really important because we know no one's going to make minimum payments and get to the end of their amortization schedule 360 months later. But if they did, look at the difference in the total amount of interest that they would paid over that time. The math doesn't work out, okay? But let me ask you this. When you see this, what's the real cost? Is the real pain that a buyer feels that oh man, I missed out on buying my house a little bit cheaper and now I'm paying an extra $100 per month? Man, that's $1,200 per year. That's a real shame. Is that the real cost of waiting though? Does anyone have a thought about that? Chime in, anybody.
Audience participation time.
All right. Well, I'll just cut to the chase, guys. The real cost of waiting, Danielle, if you want to scroll down, the real cost of waiting is they missed out on the $20,000 of appreciation in their property if they would have purchased 12 months ago. All right. That's the real point of pain that no one feels. Okay. Yes, everyone wants a lower interest rate. No one wants to pay more for their house, but look at the opportunity cost that they're missing with that appreciation in value. And remember, they could always refinance. So even if interest rates did go down, and even if the monthly payment was a little bit lower, with the house appreciating, no one's making up that $20,000 of appreciation in 1 year. That's the real point of pain. So I just wanted to put together some numbers for everyone to use in their conversations. This is the kind of stuff that I talk about with agents and with my borrowers and buyers. The waiting is rarely the answer. I mean, I think we can only identify one point in history where waiting to buy a house would have worked out, and that was right before the collapse in 2008. And we're certainly not sitting in a situation where that could potentially happen again, at least not right now. So. Um, that's all I had for today. Let me know if you have any questions. And as always, I'm willing to hop on calls with your clients and talk about it and just let me know how I can help.
Awesome. Excellent information always from Adam. Excuse me, got a little bit of a frog in my throat, if that's still a phrase that anyone uses. I find the young people look at me like I have two heads most of the time with all my little like phrases. All right, so if no one has any mortgage questions, which if you think of one, you can always jump in and ask a mortgage question at any time. He's not going anywhere. I just have a few updates as well. One is, of course, our upcoming webinars. Tomorrow, we have the webinar on scams, common real estate scams, how to avoid them, how to protect your clients, how to help them protect themselves. A lot of the information in our webinars, of course, really can be taken out and made into great blogs, graphic series, TikTok videos. So always think about the information that both Adam and I give you guys in all different formats and think about recycling them into your own social media content. That's one really great use of the stuff that we're giving you guys is don't reinvent the wheel. Don't sit and stress about social media content. Let us curate that for you and then just repackage it and rebrand it as your own. That's kind of what we're here for. So the scams is a really great one. It's just kind of giving people the tools to protect themselves. This one on the calendar there for today. So Zach, today's wasn't on the calendar. I will check with the marketing team to make sure that the market updates get put on there going forward. So thank you for that. Um, July's topic is going to be on crypto and real estate, and kind of where we see that going in the future, because I'm sure we're going to get more and more clients asking about that. So equipping you with that knowledge. And then August, we're going to do another IVRE Connect training, kind of diving deeper into some of that functionality once you guys have time to tinker with it. So that'll be good. And then, okay, so my updates. Code of Ethics. If you guys haven't seen, our NAR Code of Ethics got an update that's effective immediately. I don't love the change, but it's not up to me. So now, Standard of Practice 10-5 coming from Article 10. Article 10 is our fair housing anti-discrimination article. Standard of Practice 10-5 was actually put into effect in around 2021, post George Floyd. That standard of practice had changed to state that basically we could be held in violation of the code of ethics for any of our actions or conduct or words, no matter when we did or said them. They've dialed that back now. So now you can only be in violation of the code of ethics if your words or conduct are done in connection with a transaction. So now your private Facebook page, social media, conversations, things like that are no longer going to be scrutinized or subject to enforcement by the code of ethics. It's only if you act in a certain way during a transaction. So with clients, co-brokes, and things like that. So just know that that does take effect immediately. Um, the other thing I wanted to point out that I've been seeing a lot in my day-to-day activities, and something that you might not realize, is mobile homes. So they're not the most glorious of transactions, but they do have a place in our toolbox and in our clientele selling those. So mobile homes on land, all of us should know that, of course, the title needs to be retired in order to get traditional financing on those. But one thing that a lot of people don't realize that they can do or should do, especially in anticipation of a listing on the listing side, but I just did this for my buyer because the listing agent wasn't really doing their kind of end of the bargain, is that the title can be searched, the title for the mobile home itself, not the land, but the mobile home, of course, has its own title. You can actually search that. It gets its own title report at the DMV or whatever your state version of that department is with your state. And most states have their own version of ours is Department of Motor Vehicles, whatever your version of that is. You can actually get that report. An attorney can order that for you, or maybe you know your own process in your state. But they have their own reports, and that mobile home can have a lien on its own title separate from the land. And sometimes, not infrequently, that mobile home title may not even be in your seller's name. Okay. There are processes to fix it. Okay. But they could be lengthy and they might cost some money. But knowing those when you take the listing is, again, it's that being prepared, right? Getting ahead of issues, not causing time, stress, and money after you've got a buyer under contract, after people have given notice to landlords and kind of all, you know what I mean? So getting that stress eliminated on the front end. In my situation, my folks were USDA, and I had reached out to the seller agent and I said, hey, would your seller consider USDA? And he responded with, well, the seller doesn't know if the title's been retired. I said, well, you need that for any financing. Like thinking, how do you not know this? So I had my attorney search the title. Well, it turns out the title's not in this guy's name; it's the prior owner's name, and there's a lien on it. Like, buddy, like you can't even sell this property. They've already done like 4 price reductions. It's been on the market almost 2 months. Like this guy is not doing a great job for his seller. I'm doing the job, and we hadn't even shown the property yet. Because I don't show houses I can't sell, right? I'm not going to drag my buyers out there until I know we can put an offer on it. So I was able to do all that legwork for him. Well, here's your title report. Best of luck. And we're still working with it. We're still seeing. We did go see it. We're trying to see if we can make it work. And I've done this for several other times. So just know that that is something you can and should do. Just confirm it's retired, and if it's not, know what you're working with. They have separate little kind of title reports of their own. So I just want to point that out to people because sometimes they don't know. And then again, you're going to be to feed in with a whole bunch of people in the process when you find out that there's things that need sorted. So um, also, kind of coming up in the news a lot is that privatization of the GSEs, our government-sponsored enterprises, our Fannie Mae and Freddie Mac. And sometimes I just like to kind of um, translate. Adam and I both like to do this, just things that you're seeing in the news and people might be asking you about. And it just makes you guys sound like, a little bit like you know what you're talking about without having to look it up yourselves. And I happened to have recently taught a broker finance course, and I had this nice little chart for you. So I thought I would share it just for funsies. Our definitions of fun may vary. Um, Mine is usually a little skewed. That's why people love me. So I just have this little chart just to show you guys again, if you just get into a conversation at a networking event or anything like that, you can speak a little bit to the idea of privatizing those, Fannie and Freddie. So right now they are in a conservatorship ever since the 2008 kind of bust boom when they went into the conservatorship to make sure the housing market didn't crash. And so what does that mean? It means that as far as control, they are operated by the Federal Housing Finance Agency, which was also created at that time to oversee those major entities and set policies. All of their profits are swept to the US Treasury. Okay. But actually, recently, in recent years, they've been allowing those GSEs, those Fannie Mae, Freddie Mac, to keep their profits to help get them solvent to kind of see could they stand back on their own again. Okay. And again, as a government sponsored enterprise. Government backing is implied by government support. Kind of that same thing, kind of too big to fail. The government's not going to ever let them go under, which again makes the housing kind of situation for all of us and the investments very stable, very safe, right? Investors feel safe investing in there because they know that if something goes wrong, the government is going to still support them. Affordable housing mandates, so low, moderate to income grant programs and loan products, all of those are enforced by the Fair Housing Finance Agency. So we know those demographics are going to be supported by these agencies and by these mortgage providers. The risks to taxpayers are high, right? Because the government is going to support them. So if there is some sort of, we don't want to really call it a bailout, but a support, safety net, if that does come into play, that is coming from our tax dollars. Business decisions do require the approval of the Federal Housing Finance Agency, and whatever kind of capital requirements they need to operate are under the guidance of the Federal Housing Finance Agency. So again, right now, being in that conservatorship is very government controlled, tight guidelines, and things like that. If it comes out of the conservatorship, so it would still be a government sponsored enterprise, not fully privatized. So kind of be a step out of the conservatorship that they're in now. They would have independent management and board authority, but the Federal Housing Finance Agency would still regulate them, but they would at least have more autonomy. Okay. Profits would be kept by shareholders then, and they could also reinvest or pay dividends. Okay, so it would be operated much more like a corporation at that point, as opposed to going to the treasury, or again, right now they're just holding it in there to kind of get above water. Government backing would still have some of the GSE perks like credit lines and guarantees. So it would still be a safe investment. It would still be pretty solid as far as how it runs and operates as far as investor confidence goes. So it's still not fully privatized at that point. The affordable housing mandates would likely remain, but only enforced through regulation. The risk to taxpayers is lower. It's indirect, so it would kind of be like pre 2008, where it's not fully supported and guaranteed, but we all kind of in the back of our minds know that the government would step in at that point because they're still not going to let 2008 happen. It would have more operational freedom, and it would have to meet capital standards only for stability. There wouldn't be a direct requirements from the government. Privatization, of course, would be the next step, which would be completely hands-off government. There wouldn't be those affordable housing mandates. They wouldn't have credit lines directly to the Treasury necessarily, unless they set it up that way. It would be completely privatized, run for profit, as a corporation. So this just kind of gives you some of the ideas of how they currently operate and what the next step would be to see if they are solvent and can run on their own without that, buffer that the government has. And some of the things that we might lose in that process as well. So Fannie Mae and Freddie Mac are, stop share so you don't see all my million icons like a psychopath that I am. But there's a lot to think about. And this doesn't necessarily impact, can I send the chart? Yes. You know, it's not something that impacts us on a day-to-day basis with our clients, but as I always teach all of my students, everything we do has an impact. The economy, our local markets, our national markets, everything is intertwined. And it helps us just to have conversations intelligently with the folks that we deal with in our sphere. And then it just builds our credibility to understand how our economic system works. And Fannie Mae and Freddie Mac are just the keystone to everything we do, really. So what happens with them will trickle down to us eventually on the front lines. We will feel that. So it's important to understand. So I thought that would be just helpful since it's been in the news lately. Any questions about that?
If there's no questions about the GSE stuff, I did have a question going back to the title
Mhm.
and the manufactured home
Yeah, sure.
content. So, uh, Danielle, I don't know if we've ever had this conversation before, but the weird thing with manufactured homes on the lending side
Hmm.
is most lenders can do a manufactured home on real
Hmm.
property. Most lenders can do a single family home on a leasehold property.
Yep.
But
Hmm.
for some reason, the combination of manufactured home along with a leasehold property is
Yes.
like a no-go for all lenders. And I've heard that it requires something called a chattel loan.
Yes, well, because the reason why is because a single family on a leasehold is really handled on a deed. It's a leasehold estate, and those leases run for 99 years and they're renewable, almost in perpetuity. And those leases will get renewed so that they run for 10 years past the mortgage maturity date. So they run for 40 years. Mobile homes and parks are like apartment leases. They're annual. They're just 1 year at a time.
Mhm.
So that is the fundamental difference. If you had a mobile home, like in Middletown, Pennsylvania, on a leasehold deed, it would work because that's just the type of structure. But you have a deeded leasehold estate, which is a
Mm.
special type of less than fee free, less than fee simple interest. And some of you on the call might be familiar with like railroad properties near railroads. There might be properties where the railroad owns the land underneath the house, but you have the house on top, or along rivers sometimes, utility companies. Disneyland was actually structured that way originally as well. Or not Disneyland, I'm sorry. Trying to think of the other famous place that's a leasehold. Chinatown in San Francisco is a leasehold,
Mm.
large leasehold. All the Chinese families who started it own the land, and then people buy the buildings on top. So it's a different type of leasehold. That's why. And then yes, you get a chattel mortgage from like 21st Century or Tamac. Those are some of the ones that we use in our area.
Yeah. Because what I've seen come up recently is I have colleagues that were, hey, guess what? We can actually do a manufactured home on a leasehold property now. And then when you read into it, you get to the point where it says the lease agreement has to be longer than the mortgage, game's up. No one's gonna have a lease agreement that's longer than the mortgage.
Yep,
So
exactly.
you're
Yep.
toast.
Yep. There's one bank, Bank of Landisburg. It's a local bank here. I think I heard that might provide loans, but again, it's going to be more of a personal property loan. Interest rates are going to be higher, down payment's going to be higher. Same with even your pre-1976 mobile homes. Your local banks will do them on land, but the down payments are usually higher. Interest rates are usually a little higher just because they're portfolio loans.
Mhm.
And as a seller side, I always tell my agents when you get a pre 1976 mobile home on land, call your local bank, your local, like down home ma pa bank, ask for the terms. Yes, Landisburg Bank. Yep, exactly. Bank of Landisburg here locally is like your bread and butter portfolio bank. There's Jonestown Bank and Trust out east of us a little bit, but everyone has them in whatever area you're in. Um, Call them, get the terms, put it in agent remarks. Financing available through at 15% down. Let the buyer agents know exactly what kind of mortgage you need to have. Don't have showings on your house from buyers who can't buy it. Assume everybody else is an idiot. Just assume it, right? Because you don't want your sellers having to leave the house for FHA buyers because there's a new agent who just doesn't know. And that's okay. They just don't know yet. No one's stupid. They're just uninformed. And that's okay. Once they know, they know. And now you can help. And
Mhm.
that's how you service your seller by understanding financing.
I did have one follow-up question. Um, I see often um, manufactured and modular
Yes.
interchangeable. And I have an idea of what the difference is, but I wanted to ask you, what is the difference between modular and manufactured? Because they can be the exact same thing. However, they're the from my understanding, it's the guidelines to which it was built. In other words, they can come off the same assembly lines, they can walk, talk, and be the exact same, but they can be legally described as something different. So, what's the difference? And then also, how do we make that determination when often we see listings where it calls it a manufactured home, but really it's modular and vice versa?
Yeah, great question. And I actually have I can bring up a slide for you for that because I have slides for everything. Um, and I can show you pictures because yes, the terms are misused. So we have three different types of construction. Stick built is stick built. We all know stick built. That's what is traditional construction. Let me share my screen quick. Okay. So stick built construction, built on site, like we're used to. Modular housing is built off-site in sections in a factory, climate-controlled environment. Okay. It is brought to the site in sections and assembled on-site. Okay. But it is still stick-built construction. Okay. It's all, frame put together. It looks just like any other home. Okay. You really can't tell from the outside. This is also a modular home. It's not a good picture. The way you can tell underneath when you're in the basement, if you have a modular home, is the double beam. This is where they put the two sections together. Okay, so you can really impress your buyers when you're walking around underneath. You'd be like, oh, look, isn't this funny? It's a modular home. For our purposes, for financing, appraisals, valuation, every other way that matters, they are the same as stick built. It does not matter that it's modular. If anything, modular is sometimes considered superior to stick built construction because it is constructed in a climate controlled environment, not exposed to the elements. There was actually a lawsuit. I need to look it up because there was a lawsuit in York County, Pennsylvania, many years ago where a builder was so busy with orders, they started building them in the parking lot and they got sued for that because the deal was it was built in a climate controlled environment. So, um, then you get your manufactured homes. Manufactured homes are built in all one piece and then brought and set down on site. Okay. They might remain mobile, have a towing hitch and running gear, or they might be meant to just be housing when they get there and be set down and never moved again. There's a lot of telltale signs. Some, like this roof pitch could just be on a ranch house, no big deal. Obviously, skirting is a really obvious sign. If it stays, no one modifies it. You got your metal door jamb, your bumpy door finish, and the door will open outward, not inward. Okay, so some classic signs. Same with the center beam. We call that kind of the marriage beam where the two sides were constructed together in the factory. And they also have paneling, little seams here. The walls are like a paneling. Um, this is a good view here. It's got sometimes a cathedral ceiling, but still it's that kind of little cathedral pitch. And again, that sort of center seam down the middle where it comes together. One of the most important things about it is the metal undercarriage. All these metal framing. That's called the metal chassis. That's the one thing, no matter what anyone ever does when they renovate or remodel, they never remove the chassis. That's your classic difference between a manufactured and modular stick built. Okay. And that's what the appraiser is going to use to finally confirm and identify that this is definitely manufactured. And it doesn't matter what you do to this property. I don't care if you build the Taj Mahal around it. It is always and will always be manufactured. Um, there's, the cabinets are usually composite, other all kinds of little things, but you definitely need the HUD tag, which is this little kind of metal plate on the outside, and the HUD data plate, which is usually found in a cupboard or cabinet or closet. So if you end up selling one to a buyer, make sure they never lose these. These are essential for finance and valuation purposes. Otherwise, you'll have to pay cash, and that really diminishes the value of the home for the seller because your buyer pool shrinks extremely. Um, you can get this replaced. I think I kind of found a little process online, but it does not sound easy. And you don't want to, again, if you sell some, you're the buyer side, just say, hey, these two things, like if you remodel, repaint, whatever it is, like stick it in a file cabinet. Do not lose these. We need these for resale. Okay. These will only be on the post 1976 ones. The pre 1970 ones won't have these. Okay. So yeah, so that's the difference. Modular and stick built, price them the same, finance them the same, no one cares. But yes, you will see people mislabel those in the multi list. And so it's up to us to kind of look at all those red flags. There's tons of times where I'll see a listing and I'll go, that looks squirrely. Let me do some more digging. I got to look at more pictures. I got to look, and see what it is because I can't just trust everyone blindly. I'm an investigator. So yeah, all good questions.
Good stuff. Thank you,
Yeah.
Danielle.
Sorry, I didn't mean for it to be a whole like manufacturer training session, but
No, that's
I'll just keep
exactly what I
it.
was
I'm
looking
like,
for. Loved
I
it.
have a slide for that. Great questions. Any other questions? Yeah. So I went my first 10 years doing real estate. I never did a mobile home. I'd never done one. 10 years in, I'm like, this is my first mobile home. And then all of a sudden I became an expert. Like I just did like a ton of mobile homes and it was
Never
like, oh,
fails.
okie dokie, So yeah, I always tell people you could be 10 years doing this business. If it's your first time, get help and you just never know what you'll end up doing a lot of. So
Right
no,
on.
yeah. Yeah. So great, all great information today for sure. So if you guys ever have a topic or something you think we should cover, or if throughout the month you see a news article and you're like, oh, like I wish I knew more about it, email us, either one of us, email us and be like, hey, can you cover that article on the market update? Like you're just too busy to read the article and don't want to do it. You want us to summarize it. Send us anything. We'll cover anything. So okay. So well, great. We won't take up any more of your day. Um,
Thanks for joining in, everybody. Appreciate it.
Thank you.
yeah. Have a great rest of your day.
Take care, everybody. Thank you, Danielle.
Yep. See ya.